Hiring your spouse or kids sounds like the ultimate family bonding activity until the IRS shows up to the reunion. We need to talk about one of the most misunderstood tax strategies floating around entrepreneur circles right now. Every year, thousands of small business owners quietly put their family members on payroll, and the tax savings can be genuinely staggering. We're talking potentially tens of thousands of dollars redirected away from Uncle Sam and back into your household. So why does this strategy exist in the first place? The tax code actually encourages small business participation by family members. It's not a loophole. It's a feature baked right into the system. Here's the simple version. When your business pays a family member a wage, that wage becomes a deductible business expense, lowering your taxable income. Meanwhile, if that family member earns below the standard deduction threshold, which sits around $14,000 as of recent years, they may owe little to zero federal income tax on it. The optimism around the strategy was practically electric in personal finance communities just a few years ago. Influencers were posting things like, pay your 10-year-old to model for your business and write it all off. And people were genuinely running with that energy. But here's where the fairy tale hits a speed bump. The IRS is not impressed by creative storytelling. If the work isn't real, the wage isn't defensible, and what felt like a clever move becomes a very expensive audit souvenir. The psychological trap here is that business owners confuse technically allowed with automatically protected. Behavioral economists would call this optimism bias. We believe the rules apply to everyone. Else, until a letter with an official seal arrives in our mailbox. Historically, the IRS has challenged family employment arrangements in tax court more times than we can count, and the pattern is remarkably consistent. The cases that survive scrutiny share three things: documented work, reasonable compensation, and an actual paper trail. Think of it like a recipe. You can't just throw random ingredients into a pan and call it a legitimate business meal. The courts have seen every variation of this dish, and they know exactly when someone substituted effort for seasoning. Now, let's address the big misconception head on. Hiring family is not automatically a red flag or a scam. It becomes problematic only when the compensation doesn't match the role doesn't match reality, or the documentation doesn't exist at all. The practical playbook here is straightforward. Give your family member a real job description, pay them a market rate wage, run actual payroll, and keep timesheets like a business that expects to be audited, process over cleverness, documentation over ambition, and consistency over a one-time deduction score. What makes this strategy genuinely powerful when done correctly is that it can also fund a Roth IRA for a young adult child, giving them decades of compounding growth on money that was already going to stay in the family anyway. That's not a trick, that's architecture. At the end of the day, the discipline of doing this right separates the business owners who build generational wealth from the ones who build generational headaches. Sizing matters, documentation matters, and a rational process beats a viral tip every single time. We can be perfectly comfortable with any outcome here, whether you implement this strategy or decide the administrative overhead isn't worth it for your situation right now. The goal was never to chase a deduction. It was to understand the system well enough to make a confident, informed decision. And if you're ready to take the next step in building your financial foundation through real estate investing, working with skilled contractors, or connecting with the right lenders, check out our links in the description below.